2022 obviously was a very challenging year for investors and investment fund companies who are looking to raise equity. But amidst the economic headwinds, there have been a few success stories. And one such story that we'll be talking about today is Capital Square, which, in spite of the market downturn, managed to put together a record-setting year. Capital Square's Chief Sales Officer, James Brunger, is here with me today. James, Happy New Year. Great to see you back here on the podcast. Welcome back.
Hey, thanks, Jimmy. Great to see you. Happy New Year as well. And thanks for the kudos, too. It was a fantastic year.
Yeah, it was. And I want to get into that specifically. And I want to put some context around how it was a record-setting year for you guys and for some parts of the real estate investment industry, despite some economic headwinds that I mentioned. We'll get to that in a moment. And of course, we'll talk opportunity zones as well. But first, just to start us off, James, I'm sure that most of our audience of high net worth investors and financial advisors are very familiar with Capital Square. You guys are obviously a very big name in the tax advantaged real estate industry. But for any of our listeners and viewers who aren't yet familiar, can you give us a brief introduction to Capital Square and your role there?
Oh, yeah, sure. Absolutely. And thank you again. So Capital Square, we're a tax advantage real estate sponsor. We're based and headquartered in Richmond, Virginia, with offices in Washington, D.C., as well as Newport Beach, California. Been around 10 years, celebrated our 10th anniversary, which is fantastic. When I say tax advantage, our core competencies are around 1031 programs called Delaware Statutory Trust. Obviously, opportunity zone development programs. And in addition to that, real estate investment trusts, and then also other types of investments that provide, just by the nature of real estate, some great tax opportunities, tax saving opportunities for investors. 110 employees now, which is fantastic. It was a very big year and also a very big growth year in headcount, but well needed simply because we were trying to keep up with ourselves, which is great. So anybody on the call, anybody on the podcast who's an investor and has looked at us before, thank you for your confidence. It really was a fantastic year, and we continue to grow at a breakneck pace. Last thing, just to be clear, we are very focused in the southeastern United States, branching out to Texas and some markets in the Midwest, and very focused on multifamily solutions, both on the development side and opportunity zones, as well as anything we buy on the core side. Experience across all spectrums, but definitely we look at the lens from a housing solution side when it comes to our real estate programs.
Good. And in your role there, James, I understand you were recently given a promotion in title, at least, to Chief Sales Officer. Tell us about what you do there at the company.
Fortunately, I have my hands on a lot of different stuff. But yes, my primary goal is running the sales and distribution efforts, where I have about 20 professionals who are out in the field working primarily directly with financial advisors and registered investment advisors and their best clients on solutions for their real estate investment programs. I do also sit on investment committee. I'm on the executive committee. Like I said, I do have my hands on a lot of things. Some of my colleagues probably would like me out of some of that stuff. No, in all seriousness, I really enjoy having a good seat at the table and helping run and grow the company, which has just been a fantastic thing for the last 4 years.
Good. You guys had an incredible year. I want to talk about that in a minute. Cut to the chase, though. I'll just drop the number. You guys managed to raise over $1 billion in equity, which is rather impressive given the tough times that we were in last year with respect to the market downturn. But first, I wanted to pick up on something that you mentioned in your last response, James, which was you do have a couple of different programs that you're putting investors into. One is the Opportunity Zone program, which forms a pretty good piece of your business, but by far and away, the largest part of your business is that DST platform, that Delaware Statutory Trust platform. And there's obviously differences between those two programs, and we've covered those differences on this podcast a couple of times in the past. But you mentioned some strategies, right? You mentioned ground up development risk type strategies that typically get put into opportunity zones. Do you have any of those in your DST? Or I think maybe a DST legally has to be core or core plus holdings. Can you go into the specifics on that a little bit for us?
Yeah, absolutely. And I'm assuming you might have covered some of this before, but just as kind of a refresher, Delaware statutory trusts, they have to be core in nature. You can have no non-structural or structural improvements to the property. That's actually more around the 1031 rules than it is specific to DSTs. But DSTs themselves, in 1031, you have to have your construction finished, occupied, and the property in service for investment purposes within your 180-day time frame. So 1031, you have 45 days to name, 180 to invest. You would have to invest in a program, so essentially a development that was done within 180 days. DSTs take that restriction even kind of one step further. Really no, structural improvements associated with properties organized under Delaware statutory trust, guidelines specific to the private letter ruling that allows DSTs 2004 to qualify for 1031 exchange if organized correctly. In our case, really that limits to value add and mainly interior unit value add. You can't take a piece of land and build something new after you raise money for a DST. Really just a big against the rules. And part of the reason why is it's not necessarily in service at the time of the exchange as a income producing investment property. So there's a little bit broader approach, but I just want to be clear, specific to our programs, when we look at ground up development, they will always be either inside of an opportunity zone, primarily inside of an opportunity zone, or will be in a non-tax wrapper, LLC, or direct investment opportunity.
And I think, correct me if I'm wrong, but they probably only fall into that latter category if the location didn't fall within the geographic boundary of an opportunity zone. Is that right? Or would there be any other reason why you would do it that way?
Now you're on to us. If we find something that's really good and we like the deal, and namely some of the specifics of the deal, and we can cover a couple of these, but the specifics of the deal, housing shortage, again, we're housing focused, good job growth, great market, not a lot of competition from the development side. Even if it's not an opportunity zone, we want to be able to bring that out to investors and advisors on a nice opportunity to take advantage of looking at good return profile over time in a development project. Right. Without fail, though, you're absolutely correct, kind of alluding to this. We love to find those same type of dynamics in an opportunity zone. And primarily because we're a development company, but we're also really good operators. Since our DST programs are all core, stabilized programs, we're running those for a really long period of time. It really is making money through the operation of those programs and those properties. On opportunity zones, part of the return is developing the program, but the majority of the return, due to the long nature of the hold time frame, 10 years, really is involved on your ability to operate it well. So long-winded way of saying, absolutely, if we're looking at deals, we're looking in a market, first and foremost, what kind of opportunities does they have, right? Where are the zones, right? We get the map out and we try and figure out if we can get inside of a zone and have good solutions on that housing, on the housing front for that community in the opportunity zone, providing the best tax advantage. However, if it makes a lot of sense from a pure investment thesis, we'll certainly bring it out to market as a good development investment opportunity.
Well, thanks for that breakdown there. The difference between those two different types of programs, they are two very different strategies. I won't belabor that point. We've got other podcast episodes that went deep into the differences between those two strategies. And maybe I'll link to a couple of them in the show notes for today's episode. But wanted to get back to the intro, what I teed up in the intro, which was you guys having a great year in spite of some headwinds. James, just anecdotally, at least, I've heard from a lot of investors and fund sponsors, deal sponsors, that capital raising across the private equity real estate industry, and in particular in opportunity zones, in the first few months of the year was actually really good. DSTs in particular were flying off the shelves late last year, I should say late 21 and into 2022 for the first few weeks or a couple months. As I mentioned, OZ's had some good momentum, right? But then we had the subsequent market downturn. The first 6 months of 2022 represented the worst first 6-month period for equities in over 40 years. We had a huge downturn in the S&P 500, the broader stock market. Bonds showed some trouble. If you were in crypto, you got hammered as well. I always like to mention crypto for a second there for, for any crypto nerds. Bottom line, the markets were in turmoil. Inflation was raging. Capital raising slowed, I think, at least. Anyway, that's anecdotally what I have heard. And in general, it was just a tough year. A lot of investor uncertainty and investor hesitancy. But in spite of all that, you guys had some really good success. And I'll just read directly from your press release right now that says that in 2022, Capital Square acquired more than $2.29 billion in real estate based on investment cost, raised more than $1 billion in equity for its investment programs, and took 5 DST programs full cycle. It was a record year for you guys. What was it that you did differently to have such a successful year? Is there something unique about your strategy? And basically, why do your investors like you so much?
Yeah, they really like us. No, thank you. I'm a little embarrassed, and I'm not blushing because I'm hard to blush. But the reality is that $1 billion is just such a huge number, and it's very few short years ago, we were about 450 million in total assets under management, and today we stand at about 6.5 billion. So the trajectory has been there for us. I'll say first and foremost, the beginning of 22 was very successful for us, and a lot of that was a continuation from a massive growth in 21. We did about $840 million of equity sales in 2021. A lot of that opportunity zones actually as well. And then the first kind of quarter, we saw that continuation. And really, to your point on DSTs, the first quarter, we saw really about 225 million a week in DST sales across the industry, but only about $1 billion in total product available. So really about a 4.5-5 week supply at any given time. We really, and this goes all the way back to COVID, in our housing, properties, in all of our multifamilies, we, like everybody, when COVID hit in March of 2020, we were a little bit gun shy, and we realized after about the first month, 2 months, month and a half of collections, our collections went up and our occupancy stayed very stable and went up. And it really proved that housing is a core necessity. And even in the wake of unheralded pandemic, housing matters, and where you live matters, and people are willing to spend as well. So we started a strategy then of buying and deploying a lot of capital and really focusing on growth. I bring it all the way back then because a lot of other people in the industry, and just frankly a lot of real estate investment firms, period, across the spectrum, even the largest global ones, were pencils down. We were underwriting deals, and we carried that momentum so that we were able to have product when others weren't through 21, 22. I'll give, through the first half of 22, I give a lot of credit to our chief investment officer and now co-CEO Whit Huffman and his team. They capitalized on relationships that we became the forefront of the industry and the purchase and the acquisition side because of the activity had in 20 when the world was kind of shut down. And that carried us and continues to carry us today. We're now known as conscientious, good buyers who close on time and effectively and efficiently. And for those of you in the institutional industry, that really matters, right? When you're bidding for deals, it's often not the highest price that wins. It's those who have the ability to close on time effectively and not retrade. And so that carried us on the acquisition, the product side. Even as things slowed and the equity market slowed, we continued to move up in market share in the DST space, and even getting in deals and opportunity zones, which are coming out today, now. that time frame gave us an opportunity to expand. So I'd say that first and foremost. And then the second thing is, as you pointed out, we also have very fortunately had an outstanding and continue to have an outstanding long-term track record of full cycle and deals when we sell. We underpromise, over-deliver in general, and it's been proven out time and time again. That also helped us steal some market share when things started to slow. I will say the third quarter of 2022 is our #1 largest quarter in company history as far as equity raised. And then there was a marked slowdown in Q4 of about a 40% drop in our core 1031 business. The industry dropped by about 50% Q1 to Q4, and that has everything to do with the Fed. And again, you mentioned all of the bloodbath in a lot of the markets, why it was tough. Nobody's immune to what the Fed has tried to do with the blunt instrument of interest rates. And we've certainly seen that. We just, backing up to what you said, why do your clients like you? Underpromise, overdeliver, do it all on time or faster than expected. And over time, that confidence grows and builds really in any of the programs. And then on the other side, our clients benefit from the relationships that we carry on the acquisition side. And that is also built over time of, we will buy this at this price, at this time frame, and executing and closing and giving us the opportunity to win deals, even at maybe a slightly reduced price that benefits our investors even at the start. So a lot there to unpack, but the last thing obviously I'll mention, we have increased the sales team, we've increased the support, we've increased our investor relations. We have an investment portal now to make it easy for people to get information. And we have a really just great base of distribution through advisors and registered investment advisors who have been just outstanding for us. So those investments are other things that paid off. And really the team just got out there and got after it. It's interesting, the bloodbath that happened towards the end of the year and obviously throughout the course of the year in the equity markets. It's all, I don't want to say it was superficial, but it feels like it's not as bad as it sounds, right? So maybe that's the other thing too. We're just really optimistic. That's it. We're just optimistic all the time, Jimmy.
I think that's part of it, right? There is some infectious optimism around here, in spite of some of the headwinds that I laid out in my intro. Well, it's interesting that you mentioned that maybe there's some reason for optimism, and I can kind of paint a somewhat optimistic picture, and that is that quite a bit of capital was still raised by opportunity zones last year. And in fact, just before we hit the record button and officially went on the air here, James, you brought up the point to me that OZs actually outraised DSTs last year. Is that correct? Can you put some context around that, some numbers there?
Absolutely. So the entire 1031 DST industry, syndicated industry, raised $9.2 billion as tracked by Mountain Dell, kind of the leader in tracking, and then also backed up by Stanger, Kevin Gannon's firm. Anyway, in addition to that, Novogradac is one of the larger collectors of information associated with Opportunity Zone funding and mainly funds. Out of all the funds they tracked, Opportunity Zones raised $10 billion. So, and I just want to be clear, that's just the funds that Novogradac, a leader in the industry, a leader in information, a leader in the accounting side as well, that's just the ones that they track. So that number of how much was actually raised in OZs is probably far larger than that, $10 billion.
They estimate, sorry to interject, but they estimate that probably you need to triple or quadruple their number to arrive at the total aggregate number. I'm not sure how they figured that out, but that's their estimate of how far off they are, at least. So, but that would put us at maybe 30 billion plus raised last year, which is pretty impressive given everything we just said, right? And
considering the infancy, you have to keep in mind, Delaware statutory trust, so syndicated 1031s through DSTs, a private letter ruling 2004 gave guidance to allow for the structure to be qualified. And since then, you've seen the industry kind of grow. So really an industry that's about 18 years old, right? But in earnest, probably an industry that's maybe about 10 years old. Well, opportunity zones, 2017 Tax and Jobs Cut Act, they really didn't get off the ground until 19, right? So OZs are really about 3 years old. And it shows you that there's a massive, massive investment universe and opportunity, and also just really big growth. Part of the reason why is they function as they were originally intended to, providing capital into undercapitalized communities and allowing for that certain tax advantages for that capital to be deployed. In our case, happens to be provided housing. There's all kinds of other funds associated with private equity or investments in these undercapitalized communities. So really, it's amazing to see, and just for our purposes at Capital Square, continued focus. We have OZ7, which you see the rendering right behind me. We're launching OZ8, which is an apartment complex in Knoxville, and we're launching OZ9, which will be a kind of multi-plan phase community in Grand Junction, Colorado, really Western Colorado. But all of that's launching before March for us. And it has to do with the fact that there is great demand. I know there's less capital gains in the market, which is really a driver of some of the investment. But overall, the market in OZs are still just reaching their infancy, but they've worked. The ones that we've gone to full stabilization, we've constructed, we've gotten to the market, we've filled them up with tenants. They're operating very well. Again, a little under promise, over deliver, both on our cash flow and our refinance proceeds and our rents. So it's great, good to see. But providing that housing, the community is just rallying even more support, both on the political side and then obviously from the investment and advisor base as well. I expect it to continue. I know you have your finger on the pulse of a lot of this, but I bet you that number gets even higher this year, even with capital gains being a little bit more muted.
Well, I hope you're right. And you mentioned opportunity zones are still in their infancy, and despite DSTs having a 15-year head start on opportunity zones and already being kind of ingrained into real estate investors' psyche in terms of what a 1031 exchange is. Granted, DST's a little bit of a different beast, but it's based on a program that's now 100 years old, the 1031 exchange, right?
Right.
And in spite of that huge head start that the DST platform, if you will, marketplace, if you will, has on opportunity zones. Opportunity zones has already surpassed it by maybe 2 or 3-fold, at least the numbers last year. If you consider Novogradic's numbers, you multiply that by 3 or 4 and compare it to Mountain Dell's or to Kevin Gannon's numbers at Robert A. Stanger and Company, right? James, do I have that right?
Yeah, I think you do. And I mean, I'm smiling and laughing a little bit. I've known you quite a while now. And obviously you were kind of a leader in the information and distribution of information in a space, a platform for people to learn, number one, and then obviously see funds and opportunities to invest in opportunity zones. And, I feel like you and I, like 3 or 4 years ago, we're looking at each other going, is anybody going to pay attention to this? And now to see that the numbers have outgrown even our core business, it's really an amazing thing. I also am very fortunate to spend some time with Senator Scott, one of the funders, or one of the original underwriters and writers of the Tax and Jobs Cut Act that introduces the bipartisan legislation with Cory Booker out of New Jersey about the extension. So, I'd be happy to go into a little bit more, but there is a bill that was proposed last year and likely to hit the floor here in the near term this year that would extend the overall tax benefit and deferral time frame for opportunity zones. I only think that adds more interest and investment into the space when and if it gets passed, which looks favorably. So, for you and me to, 4 years ago, is anybody going to pay attention, be it 30, 40 billion today, 10 million reported to the main collector of information? Could it be 50, 60 billion of total equity investment, and then provide that, the original intention, which is, capital to undercapitalized communities. Really, I don't know if any legislation could be more of a home run of using, economic forces to get investment in communities that otherwise would have continued to be underinvested in. So really exciting, still very exciting in the opportunity zone space.
Yeah, no, absolutely, James. I think you're preaching to the choir now, of course. I do want to ask you a little bit more about that legislation toward the end of the episode today. Sure. I'll make sure I save a couple minutes toward the end for us to talk about that a little bit more. We've covered it a lot in 2022 since it was first introduced last April, but we'll get to that in a minute. Wanted to talk fundraising numbers with you a little bit more. That's what the bulk of this episode is about. So we were just discussing how opportunity zones, despite some headwinds, despite how new it is, and it's a little bit, maybe it's kind of a clunky program, or at least it's clunky in the sense that it takes a little bit of a learning curve. It's only a few years old, has surpassed DSTs in terms of equity raising by a pretty good amount in 2022. Now, that said, though, I look at Capital Square's numbers. I have the breakdown of the $1 billion plus that Capital Square raised last year, and your DST program is by far and away the bulk of your equity raising. $955 million you guys raised through your DST program last year, compared to $57 million through your Opportunity Zone program, all your different qualified opportunity funds. Do you expect your OZ program to grow over the next few years relative to your DST program, or are you still leaning into DSTs, where it looks like, I guess, if I'm recalling the numbers correctly, you guys have captured close to 10% of the marketplace there for DSTs. Is that right? And what's your strategy going forward with those two programs?
Sure. No, it's a great question. And I've got a couple of things to unpack there. But number one, going forward, I'll just give you scale. If we maintain that 10% market share, maybe improve it a little bit in DSTs, I'd be thrilled. For us to have grown to this spot, we've kind of reached our goal, if you will. It would be nice to get a little bit closer to 14 or 15%, but there are some really great providers in the space. In addition, I would say to us, arguably us being one of the great providers. So it's really been a nice, good maturity of the DST space, and seeing some really great real estate companies in there. For us to get up to 15%, that would be kind of the high goal. To maintain that 10 to 15%, I'd be perfectly thrilled. When we look at the growth of our business over the next few years, it really is on the backs of our development and our focus in development, which obviously is inclusive of opportunity zones. In addition to that, we have our own REIT, but the REIT is not quite as much in focus for the shorter term. It's more kind of a 3 to 5 year, but really over this year and years to come, I have targets to grow our opportunity zone business and capital raised by 300% this year, and then grow again by about 200% next year. So a big focus is in getting great programs out in the marketplace for investment opportunities. The other side to unpack there is, I made a mistake. In 2021, we had some great opportunity zone programs, and we actually sold more in equity raise in opportunity zones in 2021 than we did in 2022. My mistake is that I didn't think they would all sell out as fast as they did in 2021. So we were a little behind the curve in getting really great programs and investment opportunities out to investors in 2022. For a lack of a better term, I didn't have quite as much vision as I might have today. And we're a little bit more focused on making sure we have great programs. The last thing I unpack there, though, is we really are, and this kind of, I didn't bring this up at the beginning about Capital Square, we're focused primarily on single asset opportunity zones. We don't raise multi, and we don't raise blind pools. So what I mean by
that's why you're on fund 7 and 8 and 9 and 10 are coming up, right? You roll them out as each project is ready for equity raising, right?
That's right. And what that does is that gives, we really like that. We've listened to the advisors, we've listened to our investors. It gives them a lot of clarity of vision of what they're investing in on timeframes, on deliverables, and frankly, on the risks to a degree. And again, I'm not knocking any of my, colleagues in the industry raising money in opportunity zones. They all have the greatest of intentions and will ideally be very successful in what they do. Our vision is just one, to make sure that we have great programs fully underwritten and ready to go, or as close to underwriting as we can before we bring it out for investment opportunity. So my mistake was well intended, and thank you to everybody who invested with us in 21. But you basically sold out what I was trying to sell last year, a year early. Now, as you can tell, we have this fund, OZ7. OZ8 is actually launching next week, which is good, here in the beginning January, third week of January, which is nice. And then OZ9 will launch right at the beginning of March. So lesson learned, our sales were down. They won't be down this year because I'm going to have great product available a lot faster than I did, and working with our development side a lot faster than I did last year.
You're expecting to raise probably well over $100 million in your OZ program for 23 then?
Yep, we're targeting about 175 million in opportunity zone equity. So that'll build somewhere around 550, 600 million of property value, gross property value, gross asset value at stabilization. And then about another $7,500 million associated with non-opportunity zone development projects, again, multifamily projects, and more private equity focused. I take that in consideration when I look at my total development equity raise. But just on the OZs, you can see at 175 million will be that 300% growth goal. I will say we have a number of other projects lined up, either options, LOIs, or actually land purchased in opportunity zones. But we are waiting to see, just because their development timeframes are a little bit longer, we're going to wait to see what really happens on the extension legislation that we've mentioned.
So one thing I'm picking up on, though, is Capital Square, correct me if I'm wrong, you guys really made a name for yourself in the DST, with your DST program over the last decade plus. Opportunity zones come around and you're going in on opportunity zones, but it does require a pretty big strategy shift. You need to lean into your development skill much more so than you really don't need much in the way of development, ground up construction for DST products. So how do you make that transition, and why is now the time to make that change within your company to lean more heavily on development?
Yeah, no, great question. We're very fortunate. Adam Stiefel is our head of development. He has a long track record, and we're very fortunate. In 2018, he merged his company with Capital Square to create Capital Square Development. A lot of that under the vision of Whit Huffman, who I mentioned before, who had a pretty good background in both purchase of stabilized core real estate, but then development, specifically multifamily development all around the Washington, D.C. area, for a now publicly traded company called JBG Smith. So this sounds weird, but it's kind of in our DNA more than just acquiring core stabilized DST real estate. The Opportunity Zone program gave us an opportunity, forgive the pun, to be able to expand into one of our core competencies for really some of the leaders of our company. It was always part of the vision, where it worked really well for us when we saw the opportunity. We dug into it again, 2018, bringing the development company in-house, where we saw that opportunity is it really truly is unique to being a good developer and a very good operator. Again, the long time frame, you have 3 years or so in development, but you have 7 years in operations. So if you're a good builder operator, you're going to do pretty well. There's good firms out there like us that can do that as well. We saw that as opportunity, gave us the chance to branch. Now that we've reached and have a track record, we've reached stabilization, we've delivered 3, and now we're delivering our 4th opportunity zone project. this month, and with great results. It gives us even better opportunity to continue that. We've been able to hire very well. We did add, I can't remember what the press release says. I feel like we added 26 or 28 people last year. It's amazing to see the growth. Those people, a lot of those heavy development focused backgrounds, outstanding people that, have kind of caught the vision of where we're going. Many through relationships that we've carried from some of our other colleagues. Many, who have seen what we've been able to do and would like to participate. It's been just a great thing to see. The last thing I'll mention, even under DSTs, we've always had a construction management division that reviews before we buy properties. We always get third-party property condition assessments, PCAs, but our internal construction management headed by Mike Ollinger, they've always participated, and even in our stabilized programs, reviewing any kind of deferred maintenance capital expenses that may come up, going through with a fine-tooth comb, and then also looking at any value add opportunity and really the construction costs of that. They cross over from kind of development as well as the DST, so OZ and DST. But then on the backs of that, we've beefed up and continue to really, hire out in the opportunity zone development side of the company. The last thing I'll say is that it was always kind of part of the vision. And then sometimes you take what Congress gives you. So especially under the opportunity zone legislation, it just kind of, got us a little more motivated.
Yeah, I was going to say the Tax Cuts and Jobs Act and the OZ provision in particular kind of gave you that excuse to finally make that pivot that you guys, it sounds like you guys have been planning on looking for a way to do it. So, that said, though, we started with a rather pessimistic, bleak view of things at the beginning of the episode. We turned things around with the success story of Capital Square and all the capital that's been raised by OZs per the Novogradac numbers. But now, kind of turning ahead to 2023, what does the trajectory look like for 2023, given that there aren't a lot of gains out there, or I should say there are still a lot of gains out there, but clearly they have been diminished a lot by the downturn in the market over the last years. Is there a challenge there in raising capital for equity, I should say, for opportunity zones in 23?
Yet to be seen, because we're still seeing about the same consistent numbers that we were seeing really through the course of last year. Had a big spike at the end of 21, and that had to do with the fact that there's an additional benefit of basis adjustment. But right. I'm going to answer that question more so on development versus just opportunity zones. And the reason why, when you're a developer, it's really amazing to me, and this has been, for me, just been fascinating growth in my knowledge of real estate investments, is that you really have to be a future teller, right? You kind of have to take all of the data, all of the science, all of the trend lines, and say, 4 years from now, 3 years from now, when this building is done, this is what's going to be happening here, right? And there's risk to that. That's also why, obviously, investment returns are generally projected and can be much higher in development real estate than core real estate. You have no income while it's being done. You have all kinds of risks. You de-risk wherever you can. You get your GMP, your guaranteed maximum price on construction, et cetera. But really, you have to be a future teller. In the development side, it's kind of linear. 3-4 years from now, what does it look like, right? On the opportunity zone side, you get a little bit more forgiveness. And I say that simply because the forgiveness is, what's it look like 3-4 years from now when we deliver, but what's it look like over the next 10 years, right? Because that's really the minimum hold time frame. And so, when you have that and that ability and that vision, the current world, lack of gain, trouble in the water, interest rate spikes like we haven't seen really, in most of a generation. I'm a little bit older than our average employee, and most of them didn't experience a lot of what I've experienced in my career. You look at that, and it takes a long way of answering your question. It takes a lot less pressure of what's going on today and more about what does the future look like over time. For us, it's lack of housing, lack of quality housing. And then frankly, the more immediate theory of recency, the recent past will continue on for the indefinite future. No, interest rates won't go up forever at the fast pace of which they will. And I got news for you, inflation isn't going to stay at the same pace that it's been either, right? Again, the blunt instrument that the Fed has deployed effectively, I would say, isn't going to be around forever. And so long-winded way of answering your question, this year, it probably will be more challenged. We will be raising equity in our OZs. We will have a lot of conviction and confidence in the programs that we're putting out with the reference to risk. And there is always transaction volume and deal volume. I mean, personally, I'm just thinking, you're bringing up gains to be had. I still own Apple, at like $92 average a share. So, I mean, sure, the price is down, but is my gain gone? No. I mean, right? And I'm not a genius when it comes to investing. So I think there's a lot of people out there, and frankly, especially around opportunity zones, this is a great year if the extension occurs to get us even more attention on where this once in a generational tax haven investment opportunity is. So long answer, but don't think about the short term. Let's think about the long term.
Okay, yeah, James, that's great. And you just mentioned legislation, the extension, I should say, and I want to talk about that legislation now really briefly. Just to recap from the last few months, some OZ reform legislation was introduced into the House and the Senate last April. I was on the record as predicting that it would pass by the end of 2022. It did not. I've got egg on my face. And now we're in a new session of Congress. So now that legislation would need to get reintroduced to the floors of the Senate and the House. James, I know you mentioned earlier you've been in contact with Senator Tim Scott's office. What have you heard? What do you think is most likely in terms of when it could get reintroduced? And then when do you think it may or may not get passed?
Yeah, great question. I've been very fortunate to be in touch. And I know you have been staying in touch with the senator's office as well, and really paying attention to the legislation and bringing it up quite a bit. So thank you for that. And yes, you were wrong. It didn't get passed in 22. Sorry, man. I spoke to them this year. I've spoken with them last week, actually. And by all indication, it looks like the legislation will get into a bill form by February. It looks very favorable to get passed. There are a few holdouts there's just one holdout on the Senate side that they need to work a little bit more on. Just a reminder, it's Senator Cory Booker on the Democratic side and Senator Tim Scott on the Republican side, and they've rallied bipartisan support even for this extension of their original bill. A lot of it under the idea of reforming some things, allowing fund of funds for smaller investment opportunities. So we were talking about lower capital gain out there in the world. Well, now a fund of fund provision would give people the opportunity to go in at lower dollar amounts than many of the Reg D required amounts. Ours generally is $100,000 minimum as example. But it does look like it'll hit bill February, or at least let's just say this spring, first quarter, maybe beginning of second quarter. And Senator Scott's office does think it will pass. They have very good conviction on that, just because the final holdout on the Democratic side, there's only small kind of changes, adjustments, but it's going to take a little bit to work through that. Unfortunately, the last thing I'll say is that Congress is slightly busy with debt ceiling extension and a few other things that are going to suck the vacuum out of real legislation for a little while here.
Yeah, indeed. That seems to be the case just about every year for the last, for in recent memory, at least. Well, James, I really appreciate you joining me here today, and great insights on opportunity zones and on DSTs. I wanted to zoom out for a minute here in the last few minutes we have, and just to paint some context. Capital Square is really viewed as a leader in the private equity real estate industry. That's why I'm so glad we get you on the show again here today, James. With that said, what are some of the most powerful trends that you see playing out over the next few years across that broader private equity real estate landscape?
Great question. And we're very fortunate that Dr. Peter Linneman from the Wharton School is an economic advisor for us. He's written and rewritten and updated a white paper for us called The Golden Age of Multifamily Investing. Originally, we were in touch with him and hired to prove out some of our thesis of where we see multifamily investing, our core competency and focus, and then branch that also into multifamily development. It's been a great relationship, and frankly, it's really nice to have somebody with his team's acumen and focus to be able to provide real hard and raw data. So long-winded way of saying we still are woefully underhoused here in the United States. We do not have anywhere near the number of housing starts or the number of total housing starts needed to fulfill our current demand on housing. That includes multifamily, includes single family. One thing that is noted on that in the current market conditions, as interest rates have gone up, as affordability has gone up, you've also seen home builders basically stop. Cancellations and deliveries are going to be way down because of the current economic trouble. It takes time to restart that. So any of our kind of outlook based on some of the data from Dr. Linneman is only becoming even more challenged. And so for us, housing development, real estate will continue to be a big focus. Opportunity zone or not, that is where we will continue to branch and do more. Specifically on the private equity side, we're branching into build for rent development communities. So these are purpose-built single family or townhome communities, we call them horizontal multifamily, that are built for rent. And that's to fill the need of really two individuals and family types. Those who are not interested in extending the overall view of renting for a longer period of time, and then those who are priced out or it's unaffordable to buy. And that will grow. We see a number of statistics that will grow significantly. And that's also a play on kind of improving the overall rental stock for single family homes. Most single family rentals are, and I've owned them individually. They're, grandma's house down the street that's rented for, to a family for a long period of time and does great, but run by a mom and pop, which are many of our investors, including people like myself, as I've said. By building and managing and looking at these communities more on a holistic institutional quality, you're delivering a better product to a increasing demand structure. So I'm getting specific on our outlooks in private equity real estate, but I use that in filling a big demand for more housing, even if it's not build and sell or multifamily, et cetera. It really is just getting more housing stock into the country and into specific communities as populations have continued to increase. It's I see some data about rents coming down, et cetera. They're always quoting these big national numbers. Obviously, real estate is super local and geographic. So I really wish they would always add asterisks of nationally, rents are going down 1% after they went up 13% nationally. So you would think that's a good benefit to renters, which is great. I'd love for things to become more affordable, especially with inflation the way it is. But inflation and housing inflation really is a symptom of the long-term challenge we have in just not enough. So our goal will be continuing opportunity zone, not opportunity zone, to get more development out there and hopefully, development that resonates with investors and advisors as well.
That's great, James. It's just that simple. Just build more housing. It sounds simple anyway, but it's been a challenge for a long time in this country. Well, James, we're out of time. Thank you so much for sharing your insights today. Where can our audience of high net worth investors and advisors go to learn more about you and Capital Square?
Absolutely. Advisor-centric distribution model. So please, first and foremost, contact your financial advisor, your registered investment advisor, your wealth manager. And in addition to that, www.capitalsq.com. That's Capital Square's website. You can easily Google us as well, Capital Square 1031. any information like that will pop up on our website, contact information, more information about our offerings, history of the company, development cameras. You get to see our construction cams for all of our opportunity zone and non-opportunity zone developments, which I actually just go on and goof around a lot. My kids catch me like I'm watching YouTube or something. But thank you again, Jimmy. It's always just great to spend some time with you. I love what you're doing. It's amazing to see where the industry have gone. Someday they're going to give you an award for being on the forefront of all of this. And then maybe by then we're talking about $100 billion a year OZ industry, right? We'll see.
That'd be great, James. And final reminder for our listeners and viewers, I will have show notes available for today's episode at opportunitydb.com/podcast. And there you'll find links to all of the resources that James and I discussed on the show today. And please be sure to subscribe to us on YouTube or your favorite podcast listening platform to always get the latest episodes. James, we're out of time and your dog's barking, so I'll let you go. Thanks again.
Hey, man, have a great time. I'll see you soon, okay?
Thanks, James.